Good afternoon, everyone. Before we proceed to my topic, on which is the theories of inflation, let's have a short recap of what inflation is. Let's say Giselle goes to a corner store to buy a pack of chewing gum that costs $1. A year passed, and Giselle heads to the same corner store to buy the same pack of chewing gum, but this time it already costs $1.02. That 2% rise in the price of the chewing gum is inflation. Inflation causes a rise in prices and also causes the purchasing power to decrease. Giselle's $1 worth less today than last year. In general, the demand for goods and services in an economy is greater than the supply, causing prices to rise and therefore inflate. Now, let's proceed to my topic, which is the theories of inflation. There are two theories that economists tell us what causes inflation. These are the demand pull inflation and cost push inflation. The demand pull inflation, or the inflationary gap inflation, is the most popular type of inflation, which is a rise in the general price level resulting from an excess of aggregate demand or total spending. Demand pull inflation is often expressed as too much money chasing too few goods. We already know that when sellers are unable to supply all the goods and services to meet the buyer's demand, it results to shortage of supply, and the tendency is the sellers will raise their prices. In short, the general price level in the economy is pulled up with the pressures from buyers' total expenditures. Demand pull inflation occurs at or near full employment when the economy is operating at or near full capacity. Remember that at full employment, all the available resources in the economy are fully utilized. Therefore, the capacity of the economy to produce more goods has already been reached so that it cannot produce more goods and services given its limited resources. Moreover, take note that at full employment, all, except the frictionally and structurally unemployed, are employed, thus earning income. Therefore, total or aggregate demand for goods and services is high. Businesses find it profitable to expand their plants and production to meet the buyer's demand, but they cannot do so in the short run. As a result, national output remains at the same level. So prices rise as buyers try to outbid each other from the available limited supply of goods and services. If total spending subsides, so will the pressure on the available supply of products, and prices will not rapidly or may even fall. So here's the key point. Demand pull inflation occurs because quantity demanded is greater than quantity supplied, which tends to increase prices. The demand side is pulling prices up, which increase incomes and or a change in consumer preferences. In order for us to understand better this theory, please refer to the figure 11.2 on page 202. The 45-degree line indicates the income expenditure diagram where Y sub F is full employment output and Y1D is aggregate demand. Take note that the market clearing level of output is Y sub 1, but it is not achievable. Thus, the inflationary gap is the difference between Y sub F and Y sub 1. Keynes, in the year 1940, meant can be restated as follows. As money wages lag behind good prices in adjustment, the rise in prices will therefore lead to a distribution of income away from wage earners and towards profit earners. He posited that as workers have a great marginal propensity, the profit earners, the redistribution of income entossed by inflationary gap will thereby lead to where aggregate demand and thus close the gap. Example, the aggregate demand curve flattens and falls in figure 11 from y sub 1 to y2d. Next, we have the cost push inflation. An excess of total spending is not the only possible explanation for rising prices, as we have experienced rising prices of crude oil and domestic markets resulting in rising prices of goods and services. This is because the increase in the prices of all the products results in an increase in the cost of production of goods and services. The result is cost push inflation. Cost push inflation is a rise in the general level of prices resulting from an increase in the cost of inflation. We should remember, however, that the source of the cost push inflation is not always due to the increase in prices of oil products. Any sharp increase in cost of production of businesses can be potential source of cost push inflation. This means that upward pressure in prices can be caused by increases in the minimum wage, prices of raw materials, construction, equipment, rise in the cost of borrowing or with the interest rate, increase in the price of electricity, and so on. Businesses can also contribute to cost push inflation by raising prices to increase profits. A variant of the cost push inflation is the profit push inflation because just a handful of huge firms dominate many industries. For instance, computer, software, cigarettes, detergents, cars, and oil. These firms have the power to stock prices in those industries rather than accept the prices dictated by the market forces of supply and demand. As such, they are able to protect their profit margins by raising prices, and these firms will respond to any rise in cost by passing them on to their customers. So here's the key point. Cost push inflation refers to the production side. Higher input costs are pushing up food, clothing, and gas prices. So, to wrap this up, here are the key takeaways. Inflation is the rate at which the value of a currency is falling and consequently the general level of prices for goods and services is rising. There are two theories that economists tell us what causes inflation: demand pull inflation and cost push inflation. Inflation can be viewed positively or negatively depending on the individual viewpoint and rate of change. Those with tangible assets like property or stock commodities may like to see some inflation as that raises the value of their assets. People holding cash may not like inflation, as it erodes the value of their cash holdings. Ideally, an optimum level of inflation is required to promote the spending to a certain extent instead of saving, thereby nurturing economic growth. That concludes my report. I hope that you have learned something and have a great day.